September 29th, 2020. While the world was locked down, navigating pandemic uncertainty, the United States Department of Justice issued a press release that most people never read. JPMorgan Chase agreed to pay $920 million in fines, the largest penalty ever imposed by the Commodity Futures Trading Commission, for spoofing and manipulating precious metals markets over an 8-year period. The bank admitted wrongdoing, traders pleaded guilty, the settlement made headlines for 48 hours, then disappeared beneath the noise of daily financial news. But something else happened in that same window of time, something that received no press release, no congressional hearing, no public scrutiny. While JPMorgan was paying nearly $1 billion for manipulating silver prices downward, the bank was simultaneously accumulating the largest privately held stockpile of physical silver in modern history. Today, JPMorgan controls an estimated 600 to 750 million ounces of physical silver stored in vaults around the world. To put that in perspective, that's more silver than the Hunt brothers attempted to corner in 1980, more than most sovereign nations hold in reserve, and roughly equivalent to 60% of annual global mine supply. When silver prices drop, retail investors panic. JPMorgan does not. This is not a story about market predictions or trading advice. This is about understanding why the institutions that shape the markets behave in ways that seem contradictory to everyone watching from the outside, and why that contradiction might be the most important signal in the entire precious metals complex. Before we examine what JPMorgan knows that the public doesn't, we need to understand what is actually happening to the purchasing power of the currency in your bank account. Because silver isn't just a commodity or a speculative trade, it's a measuring stick for monetary debasement, and what it reveals about your savings is something most financial advisors will never explain. Let's start with a simple exercise. In the year 2000, the median home price in the United States was $165,000. Silver traded at around $5 per ounce. That means the average American home cost 33,000 ounces of silver. Today, that same median home costs approximately $420,000. Silver currently trades near $30 per ounce. That same house now costs 14,000 ounces of silver. The house didn't double in real value. The dollar lost half its purchasing power against tangible assets. But here's where it gets personal. If you held $100,000 in a savings account in the year 2000, that money could purchase 20,000 ounces of silver. If you held that same cash until today, earning minimal interest in a standard savings account, your $100,000 would now buy fewer than 3,500 ounces. You didn't spend a dollar. You didn't make a poor investment decision. You simply held currency, and you lost 82% of your purchasing power measured against a physical commodity that industry consumes and cannot print. This is not unique to silver. Gold, real estate, energy, food, all tangible goods have repriced against fiat currency over the past 2 decades. But silver has a unique characteristic that makes it particularly important right now. It's simultaneously a monetary metal and an irreplaceable industrial commodity. And that dual nature is creating a structural imbalance that central banks and institutions understand, but retail investors are only beginning to recognize. Now, let's return to JPMorgan, because the behavior of this institution tells you everything you need to know about the difference between price and value. Between 2010 and 2020, JPMorgan AS trading desk was actively suppressing silver prices through a practice called spoofing, placing large sell orders with no intention of executing them, creating the illusion of overwhelming supply to drive prices lower. During this exact period, JPMorgan's physical metals division was quietly accumulating physical silver at suppressed prices. The left hand pushed the price down through paper contracts. The right hand bought the physical metal at a discount. This wasn't a conspiracy theory. The Department of Justice documented it. The bank admitted it. The fine was paid. But here's the critical question. Why would a bank spend 8 years manipulating prices downward, pay a record fine, and then continue holding the physical metal? Why not liquidate and walk away? Because JPMorgan wasn't trading silver. It was accumulating a strategic position in a finite resource that the bank and analysts understand will be in structural deficit for the foreseeable future. The numbers are publicly available, but few people connect them. According to the Silver Institute's World Silver Survey, global silver demand in 2024 exceeded 1.2 billion ounces. Total mine production was 840 million ounces. That's a deficit of 360 million ounces in a single year. This isn't a temporary imbalance. It's the 4th consecutive year of deficit, and the gap is widening. Industrial demand alone reached 680 million ounces in 2024, an all-time record, driven primarily by solar panel manufacturing, electric vehicle production, 5G infrastructure, and the expanding semiconductor industry that powers artificial intelligence. Every solar panel requires approximately 20 grams of silver. Global solar installations are projected to continue growing at double-digit rates through 2030. Every electric vehicle contains between 25 and 50 grams of silver in its electrical systems. EV production is mandated to expand by government policy across North America, Europe, and Asia. Every AI data center requires silver in its server infrastructure, transformers, and electrical grid connections. Goldman Sachs estimates that data center power demand will increase 165% by 2030. Silver is not optional in these applications. There is no substitute that matches its electrical conductivity, thermal properties, and reliability at industrial scale. It is being consumed, not recycled, and the supply is not keeping pace. So when JPMorgan holds 750 million ounces of physical silver, the bank is not speculating on a price chart. It's positioning for the inevitable repricing of a depleting asset in rising structural demand. And here's what makes this positioning so revealing. JPMorgan is not a mining company. It's not a solar manufacturer or an electronics firm. It's a financial institution with access to the best commodity analysts, geological data, and economic modeling in the world. And it chose to accumulate physical silver, not gold, not platinum, not copper, but silver, and to hold it through every price correction, every bout of volatility, every headline declaring the rally over. That's not speculation. That strategic resource accumulation by an entity that manages trillions of dollars and operates with multi-decade time horizons. To understand where this leads, we need to look backward. Because this pattern isn't new. It's how wealth transfers during currency debasement cycles, and it's playing out exactly as it has throughout financial history. In 1971, the United States officially ended the convertibility of dollars into gold at $35 per ounce. At that moment, the entire global monetary system shifted from tangible backing to pure fiat, currency backed by nothing except government debt and central bank credibility. Gold was trading at $35 per ounce in 1971. By 1980, it peaked at $850 per ounce. That's a 2,400% increase in 9 years. Silver was trading at $1.50 per ounce in 1971. By 1980, it peaked at $50 per ounce, a 3,300% increase. These weren't driven by industrial demand. They were driven by the market repricing monetary metals against a currency that had lost its anchor. But here's the critical insight. The people who accumulated physical gold and silver before the repricing, quietly, steadily, while everyone else held dollars and bonds, experienced a complete transformation in purchasing power. They didn't get rich from trading or speculation. They simply held tangible assets while fiat currency was being debased through monetary expansion. Now fast forward to today. Since the 2008 financial crisis, the Federal Reserve balance sheet has expanded from $900 billion to over $8 trillion at its peak. The money supply exploded through quantitative easing, zero interest rate policy, and emergency lending programs that created trillions in new currency units. The national debt has grown from $10 trillion in 2008 to $35 trillion today. And that debt is now growing by $1 trillion approximately every 100 days. This is not a political statement. It's arithmetic. And the arithmetic tells you that the dollar is being systematically devalued against any finite resource that cannot be printed or expanded through monetary policy. Gold has repriced from $700 per ounce in 2008 to $2,700 today. That's not gold becoming more valuable. That's the dollar losing 70% of its purchasing power against gold. Silver has been slower to reprice, which is precisely why informed institutions have been accumulating it. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, currently sits near 87. Historically, that ratio has averaged between 50 and 60. During periods of monetary stress, it has dropped below 15. If silver simply returned to its historical average ratio with gold at current gold prices, silver would trade above $45 per ounce. If the ratio compressed to its monetary stress levels seen in past currency crises, silver would exceed $180 per ounce. JPMorgan accumulated its position at an average cost widely estimated between $15 and $22 per ounce over the past decade. At today's price, near $30, the bank is already sitting on an unrealized gain measured in billions. But that's not why they're holding. They are holding because the end game, the full repricing of silver against debased fiat currency and tightening physical supply, hasn't even begun. Let's strip away the complexity and explain what's actually happening at the system level. Because once you see the mechanism, the behavior of institutions like JPMorgan becomes perfectly logical. Modern currency is debt-based. Every dollar in existence was borrowed into creation by a government, corporation, or individual. That debt carries interest. The interest can only be paid by creating more debt, which creates more currency, which dilutes the value of every existing currency unit. This is not a flaw in the system, it is the system. The United States government now pays over $1 trillion per year just in interest on the national debt. That interest must be paid in dollars. The only way to generate those dollars without collapsing the economy through taxation is to issue more debt, which the Federal Reserve monetizes by expanding its balance sheet. This process is mathematically infinite until the currency loses credibility. Every major fiat currency in history has eventually collapsed or been replaced. The British pound, once the global reserve currency, has lost over 99% of its purchasing power since 1971. The dollar is following the same trajectory, just at a slower pace because it remains the global reserve currency. But that status is eroding. Central banks worldwide purchased over 1,044 tons of gold in 2024, the third consecutive year exceeding 1,000 tons. This is not normal. For decades, central banks were net sellers of gold. Now they are aggressive buyers, led by China, Russia, India, Turkey, and Poland. Why? Because these nations understand that the dollar's reserve status is structural, not permanent, and they are diversifying away from dollar-denominated assets into tangible reserves that cannot be devalued by foreign monetary policy. Silver is beginning to follow the same pattern. While central banks focus on gold, private institutions and informed investors are recognizing that silver offers the same monetary protection with even greater upside due to its industrial demand and smaller market size. The entire above-ground investment-grade silver market is worth approximately $35 billion at current prices. For context, that's smaller than the market capitalization of a single large-cap tech stock. Apple's cash reserves alone could theoretically buy the entire visible global silver investment market. The market is thin, the supply is inelastic, and the demand is structural and growing. When price dislocations occur in markets this small with this much institutional interest, the repricing is not gradual, it's convulsive. We've seen this before. In 2011, silver ran from $18 to $49 in 4 months. In 2025, silver moved from $28 to over $60 in months before correcting. These aren't smooth appreciation curves. They're liquidity events where price gaps up violently to clear chronic supply-demand imbalances. And each time, the corrections shake out retail investors who entered late and sell in panic, while institutions that understand the structural thesis accumulate at lower prices and wait for the next leg. So where does this go from here? Let's look at what the institutions are actually positioning for, not what the headlines say. JPMorgan ORS own commodities team issued a forecast in late 2024 projecting silver to reach $38 per ounce by the end of 2025, driven by industrial demand and supply constraints. That's the public forecast from the same bank that holds 750 million ounces. Think about that for a moment. They're telling you where they expect the price to go while holding a position worth over $22 billion at current prices. Other major forecasters are even more aggressive. The Silver Institute expects the structural deficit to persist through 2026 and beyond. CPM Group AES analysis shows that if just 5 to 10% of paper contract holders on the COMEX demanded physical delivery instead of cash settlement, available registered silver inventories would be exhausted within weeks. The paper-to-physical leverage ratio on the COMEX is estimated at over 300 to 1 in some analyses. That means for every ounce of physical silver in registered vaults available for delivery, there are 300 ounces worth of paper claims traded in the futures market. This works fine as long as the overwhelming majority of contracts settle in cash. But when physical demand rises and contract holders start demanding actual metal, the system experiences what's called a delivery squeeze. We're already seeing the early signs. COMEX registered silver inventories have declined significantly over the past 18 months. Premiums for physical silver coins and bars over spot price have remained elevated, indicating strong physical demand even as paper prices correct. And the spread between futures prices and physical metal prices has widened periodically, a phenomenon called backwardation that signals physical scarcity. Here's why this matters. Silver trades in two separate markets. The paper market, dominated by futures contracts, ETFs, and financial derivatives, and the physical market, where real metal changes hands for industrial use and investment. For decades, the paper market has set the price, and the physical market has followed. But when physical supply becomes constrained and industrial buyers compete with investors for limited available metal, that relationship inverts. The physical market begins trading at a premium to paper, and eventually, the paper market loses credibility as a price discovery mechanism. If that happens, and the structural deficit suggests it's not a question of if, but when, the repricing will not be orderly. It will be a scramble for physical metal at any price, driven by industrial buyers who need silver to maintain production and investors who finally recognize that paper claims are not the same as physical ownership. JPMorgan will not be scrambling. JPMorgan already has the metal. Let's be very clear about what this analysis is and what it is not. This is not investment advice. This is not a recommendation to buy, sell, or trade anything. This is a framework for understanding how institutions think about risk, allocation, and asymmetry in markets undergoing structural change. If you were managing a large portfolio and you observed the following conditions: chronic supply deficits in a commodity, rising structural industrial demand with no substitute, central banks accumulating the monetary alternative, currency debasement accelerating through debt expansion, and the largest financial institutions quietly holding record physical positions, how would you think about risk? The traditional approach is to avoid volatility, stay in cash and bonds, and trust that the system will remain stable. That approach works until the underlying currency itself becomes the risk. The alternative approach, used by institutions like JPMorgan, is to hold a portion of wealth and assets that are tangible, finite, and uncorrelated to financial system risk. Physical silver fits that criteria, but physical means physical, not a futures contract, not a leveraged ETF, not a promise from a custodian that may settle in cash during a supply squeeze. Physical metal that you can verify, store, and control. The distinction matters because in every historical supply squeeze, the entities holding paper claims discovered that physical delivery was either impossible, delayed, or settled in cash at suppressed prices. The entities holding physical metal had optionality. They could sell at market prices, hold through volatility, or wait for repricing. The difference between holding a claim and holding the asset is the difference between counterparty risk and tangible ownership. Institutions understand this. That's why JPMorgan holds 750 million ounces of metal, not 750 million ounces worth of futures contracts. The allocation question is personal and depends entirely on individual circumstances, risk tolerance, and time horizon. But the underlying logic is universal. If you believe currency is being debased, finite tangible assets reprice upward. If you believe industrial demand for a commodity will exceed supply, prices must rise, or demand must be destroyed. And if you believe the paper market for that commodity is leveraged far beyond physical availability, the gap between paper price and physical value will eventually close violently. These are not speculative beliefs. They are observable facts playing out in real time. The only question is timing. And timing is where institutions have an advantage over individuals. They can wait. They don't need liquidity tomorrow. They operate on decade-long time horizons and can endure volatility that would force an individual investor to sell. That's why understanding their behavior is so valuable. Not to copy it trade for trade, but to understand the structural thesis they're positioning for and ask yourself, do I see the same conditions they see? And if so, am I prepared? Or am I assuming the system will remain stable indefinitely? And there's a concept in game theory called the closing window. It describes the period during which an action is available but becoming progressively more difficult or expensive to execute. Right now, physical silver is available at retail. You can walk into a dealer, place an order online, and take delivery within days. Premiums are elevated but not prohibitive. The market functions. But supply windows close when demand surges and inventories deplete. We saw this during the 2020 pandemic when premiums on physical silver spiked to over 50% above spot prices and delivery delays extended to 12 weeks. We saw it again in early 2025 when retail shortages emerged despite paper prices remaining relatively stable. Each time, the window reopened as supply chains adjusted. But structural deficits are different from demand spikes. Demand spikes are temporary. Structural deficits persist until either supply increases dramatically, demand is destroyed by high prices, or substitution occurs. Silver supply cannot increase quickly. It takes 7 to 10 years to bring a new silver mine into production, and most silver is produced as a byproduct of copper, lead, and zinc mining. Primary silver mines are rare and expensive to develop. Demand is not being destroyed. Industrial consumers are price insensitive up to a point because silver represents a tiny fraction of the cost of a solar panel or an electric vehicle, and there is no substitute that performs equivalently. And substitution is not viable at scale. Engineers have spent decades trying to replace silver in critical applications. In most cases, the alternatives either don't work as well or cost more than silver itself. That means the structural deficit will persist until price rises enough to ration demand, which means significantly higher prices than today, or until new supply comes online, which will take years. The window for accumulating physical silver at current prices is not closed, but it is narrowing. Not because of speculation or hype, but because of arithmetic. If industrial demand continues growing at current rates and mine supply remains flat, the deficit compounds. If investor demand increases even modestly, it overwhelms available supply in a market this small. And if confidence in paper markets erodes and delivery requests spike, the entire pricing mechanism breaks. JPMorgan is already positioned. Central banks are accumulating gold. Informed private investors are moving into physical metals. The remaining question is whether the average person, watching from the outside, recognizes the pattern before the window closes entirely. Not whether silver goes up tomorrow or next month, but whether the structural imbalance that took years to build will eventually force a repricing measured not in percentage points, but in multiples. Let's end where we began. September 29th, 2020, JPMorgan pays $920 million for manipulating silver prices downward. And on that same day, in vaults scattered across the world, the bank holds hundreds of millions of ounces of the same metal it was fined for suppressing. That is not irony. That is strategy. The fine was the cost of doing business. The metal is the business. And the reason JPMorgan never panics when silver prices drop is because the bank is not trading volatility. It's holding a finite resource and structural deficit during a period of accelerating currency debasement. The price on any given day is noise. The supply-demand imbalance is signal. And the signal is getting louder. So here's the question worth asking yourself. When the largest financial institutions in the world are quietly accumulating a physical asset, when central banks are buying gold at record pace, when industrial demand for silver is outpacing mine supply for 4 consecutive years, when the paper market is leveraged 300 to 1 against physical availability, and when the currency you hold in your bank account is being systematically diluted through debt expansion that shows no sign of slowing, what does preparation look like? Not speculation, not trading. Preparation. Because the difference between those who preserve purchasing power during currency debasement cycles and those who lose it quietly is not intelligence or access to insider information. It is simply recognizing what S happening before the majority does and acting while the window is still open. JPMorgan recognized it. Central banks recognized it. The industrial buyers consuming 680 million ounces per year recognize it. The only question left is whether you do. And if you do, what you're willing to do about it while physical metal is still available at prices the institutions accumulated years ago. History doesn't repeat, but it rhymes. And right now it's rhyming with 1971. The question is whether you're listening.